Give us your take on how markets are reacting to where oil prices are, to where commodities are right now.
Good morning. I think markets are reacting the way they should be, given the uncertainty with the geopolitical tensions and rising energy prices. I think higher oil prices are going to impact the inflation, and that it's going to make very challenging for central banks to step back and not hike policy rate. So on one hand, you will see higher expenditure in terms of the consumer wallet, and at the same time, interest rates will go up. So that's going to be very negative for the asset prices. And we were expecting the equity market to see a pullback of 5 to 10% because of this geopolitical tension, and we are seeing that playing out in the market right now.
Suresh, we're seeing metals continue to rally. Nickel extending its rally to 16% on the back of that Russia risk. I mean, is it time to perhaps cut your exposure to equities at this point in time, given what's transpired?
I don't think this is a time to cut exposure, especially when markets have already factored in a lot of the bad news. If you look at the broader picture, the growth environment is still healthy, especially in the US economy, because US has very little exposure to Russia, and even the dependence on energy is much lower. So we think the global growth can still remain healthy, and that's why the equities could be supported. But what investors should do is to focus on sectors and markets which benefit from higher inflation and higher rates. So at sector level, we like energy and financials, which tend to do well in this kind of scenario. And at market level, I think Japan should do well.
Suresh, how much of this is also froth here? Is it a speculative frenzy mainly? And how does that match up with supply and demand? Because not all these markets are tight.
Yeah, especially if you look at the equity market, we know that for the last 2 years, retail investors have been heavily investing in the market. So now we are seeing some sort of capitulation taking place. And that's why we are seeing sharp drawdown in equities, especially in Europe, which is getting impacted more by the higher energy cost and close links with Russia. But end of the day, what matters for equity market is the earnings picture. And we think the earnings are still going to be supportive. They are going to be higher this year, at least high single digit. And that's going to support the equity market once the dust settles.
All right, Suresh, also just when we see what is going on, is it time to run for the hills? Is it time to get into cash? What's the deal?
I think investors should take some defensive exposure within their portfolio to hedge against this risk. But I don't think cash is going to cut it, given the high inflation. So the way to hedge your exposure would be to look at defense stock or cybersecurity stocks, because they will benefit from this geopolitical tension. In the equity market, you look at the sectors like energy and financials, they tend to do well in this high inflationary scenario. In the bond market, look at Chinese government bonds. I think they will benefit given that China is going to ease policy going forward compared to what other central banks will do. So cash, I think you most likely lose money, but if you take exposure to these instruments and solutions, I think they will provide better hedge.
And your thoughts on how to play China, Suresh? Right now, we have China's NDRC vice chair saying that commodity price stability is important to the economy. This is on the back, of course, of its target of 5.5%, which some say is pretty ambitious.
Certainly, the target is very ambitious. What we have been a bit disappointing by is that there have been no easing in terms of the pressure on the property market or on the regulatory overhang on the technology stocks. The NPC reiterated the view that housing is for living, not for speculation. So no easing on the property sector means the economic growth will be very hard to achieve. At the same time, on the technology sector also, the NPC reiterated the view that they are going to clamp down on the monopolistic behavior and unfair trade practices. So these two sectors, I think, could remain under pressure. The way to play the Chinese equity market will be to look at the sectors which are being supported by the government. And those would be 5G, clean energy, electric vehicles. So all these sectors, I think, should continue to do well.